So when you total up all these numbers, that's the total operating expenses. Now, you take that away from the effective gross income. And that's going to bring you to the lifeblood of what this business is about. That's going to bring you to what's called the net operating income, right? The net operating income is what's left over after you've collected all your rents and your other income and you've paid out all your operating expenses, but you haven't paid your mortgage yet, right? Key, a mortgage is not an operating expense. It's what's called debt service. You're servicing the debt. If you paid cash for this building and you had no mortgage, you're still gonna have property taxes, you're still gonna have insurance, you're still gonna have all the stuff we just talked about, right? So the net operating income is basically what's left after you collect the rents and pay your bills, but before you pay your mortgage. This is the value of the property. Because why is this the value of the property? This is the money you have to pay your mortgage with, and this is the money you have to pay yourself with. Make sure you're planning on paying yourself, because the business is tough, the economy is tough, stuff happens, you have to plan on paying yourself. If you don't plan on making money, you're gonna lose money, 9 times out of 10. Unless you're just really lucky, right? So this is why, though, it's specifically the value. I mean, what I just was telling you, that's why it's valuable, that's why it's the value of the building. But here's why actually it's the value of the building. So when an appraiser comes to appraise your income property, this also goes for any other type of commercial income property, they're gonna capitalize the income, right? And that's how they come up with a value. And they're capitalizing the net operating income, not the gross income, the net operating income. There's some other factors like gross rent multiplier. I try not to look at the gross rent multiplier a lot. Here's why. Gross rent multiplier does not take into account operating expenses. And operating expenses can vary wildly. So I always look at the net operating income and utilize the capitalization rate to get to the value, because that's how appraisers are going to look at it. So what is cap rate? Well, capitalization rate, is known as cap rate. So if you hear somebody say cap rate, that means capitalization rate. What is it? Essentially, it's the rate of return generated by a real estate investment property based on the annual net operating income, the annual NOI that the property generates. Basically, in layman's terms, it represents the percentage return you would get from a building if you paid cash and didn't have a mortgage payment, all right? Here's an example of that. Say I went out and I had a boatload of cash, I won the lottery, or I just signed a big contract, whatever. I got a bunch of money. I went out and bought a building for $1 million. So that price is $1 million. That building generates a $100,000 net operating income. What's the net operating income? It's what's left over after you collect your rents and your other income and you pay out all your operating expenses, right? So remember, I don't have a mortgage on the property. So how much money a year do I put in my pocket? Wild guess. 100 grand. That's my net operating income. I got no mortgage, right? I paid cash for it. Paid all my bills. I generated I took in all my rents, paid out all my bills. 100 grand was left over. That's my NOI. I paid $1 million for the building. That represents a 10% cap rate, 10% capitalization rate, right? Because 100 grand is what percentage of $1 million? 10%, right? It's simple math, right? 10% of $1 million is 10% cap rate. Now, these numbers are inversely related. I don't want to go too deep into math. I don't want to bore anybody, right? But the numbers are inversely related. So that means if I have two of these numbers, cap rate, NOI, price and or value, I can come up with the other number. Right now, if I find an 8% cap rate in East Oakland, I'm doing great, because the average is probably about 7.5. A couple years ago, I'm finding 9 and 10% cap rates all day long. So understand this, a cap rate is the higher the better when you buy, because that means a higher rate of return. When you sell, the lower the better, because now, basically, you're in a better market condition. You want to sell in a better market condition, right? And you want to buy, ideally, when things are softer. So right now, I like to deal in a lot of neighborhoods like East Oakland, because it's, well, I wouldn't call it a distressed neighborhood. I would like to call it a lower to moderate income. I certainly wouldn't call it distressed. I'd say lower to moderate income. Why? Because there's more people like that. There's more people out there. There's more people making less money than there is making a lot of money. You talked about the rich and the poor. How many poor people versus how many rich people are there, right? So who makes more money, Walmart or Scott's? You know what I mean? Or Walmart or Neiman Marcus. That's probably a better comparison, right? Who makes more money? All right. So that's my philosophy. There's a lot of people who stick only to high-end neighborhoods, San Francisco or by the lake, and they make a ton of money too. Everybody's got their thing. But I like neighborhoods like East Oakland, where there's more people, it's a little bit simpler, and then I'm familiar with that. So if I can find anything 7.5 and above, I'm doing great right now. If I was to say, hey, I want to go into San Francisco, I think if I'm finding any 3.5% and above, I'm hitting a home run. You know what I mean? No, really, seriously. I think if I'm out in Stockton, Sacramento, I want to try to be 8.5, 9. Although those are becoming harder to find too. So it just depends on the market. It depends on where you are, and then also what your goals are. Therefore, don't be afraid of out of state. When I first started, my first deal was in Pueblo, Colorado, 2003. It was my first ever real estate deal, right? And I was here in California. At that time, out-of-state investing was real popular. When the market crashed, it only made sense for people to stay local because the prices were cheaper than really they hadn't been in a long time. So if you're saying, based on your plan that you set up and said, this is what I want to achieve in my investment life, I need higher cash flow, then that may mean you may have to leave out of the Bay Area. Doesn't mean you have to, but that just depends on your plan and maybe your lifestyle. Maybe you travel a lot already, and maybe that's easy to do, or maybe you got 3 or 4 kids and you don't travel, so you can't do that. So that's why having a plan specific to your life is important, because that's going to dictate, you know, what cap rate you're looking for, what areas you're looking for, so on and so forth. That make sense? But I would say here in the Bay, well, here in Oakland, 7.5% in East Oakland, West Oakland. If you're downtown Oakland, you're looking at 5.5, 6. If you're by the lake, 4.5, 5. If you're in San Francisco, if you're doing anything above 3.5 is outstanding. Stockton, Sacramento, I'm looking for 8+.